Hi there, I had to walk into this earnings week from scratch. Knowing what I know about the AI trade, the software reset, and the way this market is punishing even decent reports right now, I would not do the easy thing. I would not just see a red candle and say, fantastic, buy the dip. That's how people get trapped. Most investors think earnings season is about whether a company beats or misses. But that is only the first layer. The real question is, did the report make the future look better, worse, or just more confusing? And in this market, confusion gets sold first and analyzed later. Today is Tuesday, May 5th, New York time, and comment below what day and date you're watching from, because in a week like this, one trading session can completely change the story. And if this kind of clear market breakdown helps you, subscribe and comment John A.G. Best below. It lets me know you want the deeper work, not the quick copycat noise. So here's the setup. Palantir delivered one of those quarters where the business looks almost ridiculous, in a good way. Duolingo also put up solid numbers, but the market did not like the direction of the strategy. PayPal and Shopify are next in the morning window. AMD comes after the close. Uber is right behind them. And all of this is happening while AI stocks have already bounced hard, software is trying to rebuild trust, and macro headlines can still walk into the room and knock everything over. So this is not a normal buy the dip week, this is a sorting week. Strong companies will be separated from strong stories. Real demand will be separated from hopeful guidance. And the market is going to ask a very uncomfortable question. Are these stocks actually cheaper, or did expectations just get too expensive? Let's start with the rule that matters most. A stock being down does not automatically make it a better deal. If the price falls but estimates fall too, nothing got cheaper. You just paid a lower price for a smaller future. That's the part people miss. They say, well, it was down around 10%, so it must be 10% cheaper. No, not if guidance came down. Not if margins are under pressure. Not if growth is slowing faster than the multiple is compressing. That's not a discount, that's a warning label. Now, on the other side, if a business reports well, raises expectations, and the stock still dips because traders were crowded, that's different. That can become interesting. But you have to know which kind of dip you're looking at. Palantir is the cleanest example of the good problem. Based on recently published numbers, revenue jumped roughly 85% from last year. U.S. revenue more than doubled, and U.S. commercial revenue grew even faster than that. The company also raised its full-year revenue outlook into the mid-7 billion range, which tells you management is not just celebrating the last quarter, they're leaning into the next one. That is not normal software growth. That's not a company growing low double digits and begging investors to call it AI. This is contracts, government demand, commercial adoption, billings, backlog, and free cash flow showing up together. And when a company grows that fast while expanding operating power, the bears have a problem. They can still say the stock is expensive, and maybe it is. But expensive is not the same thing as fake. The funny thing is, even with numbers like that, the stock does not have to explode. That's the dangerous part. When investors already expect greatness, a great quarter may only keep the story alive. It may not be enough to create a brand new rally. That's why Palantir is both impressive and tricky. The company is executing like very few public software businesses, but the stock is carrying expectations that are not exactly humble. And that's where the counterpoint comes in. If you own a business priced like it needs to keep shocking the market, then eventually normal excellence can feel like disappointment. That's not bearish. That's just valuation gravity. Now compare that with Duolingo. Duolingo's quarter was not a disaster. Daily active users rose around 20%. Paid subscribers rose around the same pace. Revenue grew in the high 20s. Bookings grew too, but slower. And that is where the market started squinting. The company is still profitable. It still has a lot of cash. It still has a product people know, use, joke about, and in many cases genuinely love. But the stock got hit because the market is not grading yesterday's numbers. It's grading tomorrow's monetization. Duolingo is basically saying, we want to make the learning experience better, especially for free users. And we want speaking practice, AI features, math, music, and other products to make the platform more useful. I actually understand that. If your mission is education, then making the product better is not some crazy detour. Speaking has always been one of the hardest parts of language learning. If AI makes that cheaper, more available, and more personalized, that's a real product improvement. But the market's response is simple. Nice story, show me the money, because AI features are not free. More speaking practice can mean more inference cost. More free trials can help engagement, but they delay revenue. More focus on outcomes can help long-term retention, but it can pressure near-term bookings. And when gross margin is expected to drift lower through the year as AI feature usage expands, investors start asking whether the product improvement is coming before the business model proof. That's why Duolingo is now a prove-it stock. Not broken, not garbage, not finished. Just prove it. And prove it names need evidence, not speeches. This is also why PayPal matters. PayPal has been in the penalty box for a long time. The company recently moved toward a simpler structure with checkout, consumer financial services around Venmo, and payment services with crypto and Braintree grouped more clearly. That sounds boring, I know. Corporate structure is not exactly popcorn entertainment, but in a turnaround, structure matters because structure tells you where accountability lives. The question is whether PayPal can make branded checkout feel important again. Can Venmo become more than a money-sending habit between friends? Can Braintree keep volume without dragging down profitability? Can new leadership sound specific instead of giving investors another soft-focused turnaround sermon? That's what I'm watching. Not just earnings per share, not just revenue. I want to know whether the business has a sharper identity. Because PayPal's problem has not been that nobody has heard of it. Everybody has heard of it. The problem is that the market has not been convinced that hearing of it still means growing with it. Shopify is another one where the headline number is only part of the story. Shopify is tied to merchants, small business formation, online spending, point of sale expansion, and now AI commerce tools. If merchants are healthy, the platform can keep compounding. If consumers slow down or merchants pull back, the story gets more complicated. And with Shopify, the market always asks two questions at the same time. Is growth durable, and can expenses stay disciplined while they keep building? Then we have Uber. I think Uber is one of the more misunderstood setups because people keep trying to make it one thing. Is it rides? Is it delivery? Is it ads? Is it logistics? Is it an autonomous vehicle story? Honestly, it is a platform with several engines attached to it. The latest company numbers showed record quarterly cash flow, strong trip growth, and a very large full-year free cash flow base. That doesn't mean the stock has no risk. It means the business is not some little experiment anymore. The autonomous threat is real, but I think the simplistic version is wrong. People say robotaxis come, Uber loses. Maybe. But maybe Uber becomes a distribution layer. Maybe cities move slowly. Maybe fleet ownership is harder than the demo videos make it look. Maybe insurance, regulation, pickup density, weather, safety, and local politics turn this into a long transition instead of an overnight replacement. So with Uber, I am not ignoring the threat. I am asking whether the market is overpricing the speed of the threat. Now let's get to AMD, because AMD is the one that can shake the whole AI mood. AMD reports after the close, and the bar is high. The company entered this year with strong momentum across data center AI, ePYC server CPUs, Ryzen, and the broader high-performance portfolio. The market is watching the AI accelerator roadmap, especially the next major product cycle, because investors are trying to decide whether AMD is truly the alternative in AI chips, or just the popular second name people buy when they miss the leader. And that matters, because if AMD gives clean demand commentary, strong data center visibility, a credible roadmap, and margins that don't scare people, the stock can keep its momentum. But if any piece sounds soft, the reaction can be ugly. Not because AMD is a bad company, because the stock already has a lot of good news sitting inside it. That's the whole lesson of this week. Good companies can drop, bad setups can bounce, strong reports can get sold, messy reports can squeeze. Earnings season is not fair. It's not supposed to be fair. It is a fast repricing machine. So here's what I'm doing. I'm not chasing everything. I'm building buckets. Bucket 1 is companies where the business is getting stronger but the stock is expensive. Palantir fits there. Bucket 2 is companies where the product is strong but the market needs proof. Duolingo fits there. Bucket 3 is turnaround names where management has to earn back trust. PayPal fits there. Bucket 4 is momentum names where the report has to justify the run. AMD fits there. And bucket 5 is misunderstood cash flow stories where the debate is bigger than one quarter. Uber fits there. If you're successful, share your success story in the comments so others can stay motivated, not to brag. To remind people that patience and discipline can actually work. The worst thing you can do this week is treat every dip the same. A valuation dip is different from a guidance dip. A sentiment dip is different from a thesis-breaking dip. A crowded trade pullback is different from a company telling you growth is slowing for real. You have to diagnose the fall before you buy the fall. And yes, that takes more time. It is easier to yell, buy the dip, and feel brave. But brave is not the goal. Wealth building is the goal. The goal is to own great companies when the price, the business, and the future line up enough to make the risk worth it. So if the market drops this week, don't panic and don't celebrate too early. Ask why. Did estimates change? Did margins change? Did demand change? Did guidance change? Did management sound confident or defensive? Did the stock fall because the business weakened or because traders got greedy into the print? That's the checklist. And remember this, in a market this emotional doing nothing is still a position. Sometimes cash for 2 more days is not cowardice. Sometimes it's oxygen. It gives you the ability to buy when the dust clears instead of when the chart is still screaming. So keep your watch list ready. Keep your ego out of it. Let the reports come to you. Palantir showed what real AI demand can look like. Duolingo showed why strategy pivots need patience and proof. PayPal has to show focus. Shopify has to show durable merchant strength. Uber has to show the platform keeps compounding. AMD has to show the AI hardware story is still accelerating, not just exciting. That's the week. Not simple, but very useful if you know how to read it. One more piece matters here, and it is the part nobody wants to talk about when the market is green. The software market is going through a trust reset. For 2 years, almost every company said AI would make them more important. Fine. Now the market is asking, where is the actual revenue, where is the actual margin, and where is the actual customer urgency? ServiceNow is trying to answer that with long-range targets and an AI workflow story that says old systems will not disappear. They will be controlled through a smarter layer. That is a reasonable argument. But again, the burden is proof. That's why some software names can rally brutally after one strong update. If a company had been treated like growth was dead, and then it shows that customers are still spending, guidance can re-rate the stock overnight. But the reverse is also true. If a company has already bounced and then management sounds unsure, the market will not wait politely for the next quarter. It will punish first. The macro backdrop adds another layer. Rate expectations, treasury yields, dollar moves, oil headlines, and geopolitical tension can all hit at once. This matters because earnings do not happen in a vacuum. A stock can report well and still fall if the broader market decides risk appetite is gone for the day. And a weak report can bounce if investors were already positioned too negatively. That's why I don't want one simple rule. I want context. So for me, this week is not about predicting the exact closing price of AMD or PayPal or Shopify. That's a television game. The real work is deciding what new information would actually change my view. If AMD proves demand is bigger and more durable than expected, that's information. If Duolingo shows engagement is improving but monetization is weakening, that's information too. If PayPal reorganizes but still cannot explain why customers should use it more, that's information. If Uber keeps throwing off cash while the autonomous timeline remains uncertain, that's information. Your job is not to react to noise. Your job is to update your model. And this is where calm beats speed almost every single time. And before we close, here's the human version. You don't need to catch every move. You don't need to own every winner. You don't need to predict every after-hours reaction. You need a repeatable process because the people who survive markets are not the people who always sound the most confident. They're the people who can change their mind when facts change and stay patient when facts have not changed. Everything in this video is for education and market discussion only. It is not financial advice, and it is not a recommendation to buy, sell, or hold any stock. Earnings can move fast, headlines can flip sentiment, and your risk tolerance is your responsibility. Do your own work, check the numbers yourself, and never let one exciting market week make permanent decisions for your financial life.